This is David Locker from bngloans.com. And today I've put together a quick training about business cash advances, in which we're going to discuss the current market for business cash advances and then talk about some of the things that you need to look out for. And then we're going to discuss the ideal scenario for funding your business and how to actually achieve that. All right, so a quick summary on business cash advances is traditional banks are offering these types of cash advances through credit lines to a select few businesses that already have an established reputation in their banking system. And what that means is that they've already qualified for that specific financial institution's loan criteria. And typically that's the 680 plus credit score, low 5 bank ratings, verifiable cash flow, responsible bank account management, etc. We talk about all these things very in depth at bngloans.com. But due to the successive criteria and the inability for most businesses to get that traditional funding, there's been a growing need for an alternative. And it's been more specifically targeted to business cash advances or merchant cash advances or fast small business loans, quick business loans, so on and so forth. Now, they're becoming widely popular due to those loan and credit line denials by traditional banks and financial companies because they're trying to fill a gap. And the gap's being filled by the alternative lending companies through excessive advertising in these cash advance spaces. So that presents its own unique set of challenges, which we are about to cover next. As far as terms with business cash advances through alternative lending companies, they're often accompanied by extremely high interest rates and fees and penalties due to the increased risk that's associated with the loan or line of credit. But it's somewhat justified, or it's apparently justified by that less stringent criteria for approval and them getting those loans and the funds to you quickly. So that's kind of their excuse. So a word of caution here is it's easy to overlook those bad terms when you're in a rush or you're worried about being denied by traditional lenders, or you have been denied by traditional lenders because you're somewhat desperate. You want to maintain your business, you want to increase your business, you want to expand your business, but you can't do so because traditional banks and financing companies aren't giving you the funding that you need. So you don't have much alternative. Now, the solution to the problem from the start is having the right financial foundation marks in place and having a plethora of loan and line of credit options to cherry pick the best terms for the funding that you need for your business. But if we're being realistic, that's not always possible. So if you elect for the types of loans that alternative lending companies are offering you, like business cash advances or merchant cash advances or fast small business loans or super quick funding, so on and so forth, then you need to insist on transparency of fees and any penalties that are associated to being late on a payment or anything like that, because it can boost your interest rate from 15% or 12% or 10% to 200% if they assess a penalty. So you need to have a complete understanding of exactly what you're getting yourself into. Now, it's good practice to have certain parameters set in place, and what we recommend is that you calculate 30% of half the potential profit of the loan as a direct result of the loan. Now, if the total loan cost is more than that, then you need to consider different funding options. And I'll give you a quick example of what it is that I'm talking about. Say your business has a piece of equipment, and that piece of equipment makes a $1,000 net profit per month. Now, you get a loan for 2 pieces of equipment at $50,000. Now, your potential return is $2,000 per month due to the increased efficiency and productivity of those 2 new pieces of equipment. Now, be sure that you include demand probability here as well, such as requests to meet the certain productivity, which could indicate more probability of achieving that $2,000 per month additional income stream. And once you take that potential profit, which in our case we're saying is $2,000 per month, we want to cut that in half to allow for potential issues that are out of your control, which we call variable change. So now we're at $1,000 per month of potential profit. And then you calculate 30% of that, which 30% of 1,000 would be 300. Now, if the cost of the loan per month and interest and fees, not principal, just interest and fees, is more than 30% of half potential profit, then you need to consider searching for better terms, because we strongly believe that you can achieve those better terms, especially if you follow the steps to creating the ideal scenario that we lay out here in a second. So another thing is, if your potential profit is already in hand or it's under contract, then you can increase that initial half cut that we went from 2,000 to 1,000, but you want to still allow for variable change. So I wouldn't recommend cutting less than 25% from that potential profit. So if you go to 20%, that's not a good idea. You still want to account for variable change. All right, so next we wanted to discuss the ideal scenario. We receive a lot of questions about whether a specific loan or line of credit is the right financing decision for a business. and whether there would be other alternatives that would have better terms. Now, the answer to that question is difficult to predict given the variables on both the businesses and the lender's side. So we would like to propose a better question, which is what we feel business owners should be asking. And that's, how do I find the best loans or lines of credit with the best terms for my exact financial situation? Now, I know this may seem obvious, but if you've spent any time researching up to this point, then you know how vague financing companies can be when they are trying to get you to apply for a loan. And the reason is they don't want to deter you from applying. Lenders and financial advisors have quotas to meet, and the criteria is sometimes a little bit more lenient than, say other times of the month. So if they put hard criteria down on their application or their website, then they could lose the chance of you applying in the first place. And that leads to businesses applying to loans that they're not qualified for or wouldn't be a good option for their business, and then they're denied without much explanation as to why. So the solution to the problem is knowing your business's fundability from the start, and then understanding how it coincides with the specific lending criteria prior to applying for any loans or lines of credit. Now, this allows you to make the necessary adjustments to ensure that you're approved prior to ever applying. So we strongly recommend that you acquire your business fundability score. And you can do that by taking a short test that's available through our website at bngloans.com. And this is a no-cost test, and it's a lot like looking at the exam the day before you have to take it, so you know exactly what you need to study. Now, this isn't like a test in the true sense of the word or something that you have to study for, but we call it a test because it's a rating or a scoring of your business, if you will. And the study part comes when you're fixing any of the problems prior to needing to pass the lender's test when you actually apply for a loan or line of credit. Now, what the test does is it provides invaluable insight into your business's financial foundation. And it's going to allow you to see exactly what loans or lines of credit that you're pre-qualified for right now. And it does this all without creating an inquiry on your credit report. So if you were to go off and apply to a bunch of loans and lines of credit, that creates an inquiry on your credit report. And if you consistently do that, then it's a negative impact. So the unique advantage here is that you're going to see your business from a lender's perspective. And you're going to know if there's anything that should be corrected prior to ever applying for a loan or line of credit. Now, this creates the potential for that ideal scenario of having multiple funding options available to you where you can pick the best terms for your business's circumstance. And it's going to help you determine exactly how to achieve that scenario. But it all starts with the business fundability test, which you can access the test below the video. It's only going to take you about 10 minutes of your time, and it provides an extremely valuable resource for you getting the funding that you need. Now, we know your time is valuable, so we promise not to waste it. I want to thank you for watching this video, and I truly hope it has given you a great insight on your next steps to getting business funding. This is David Locker for BNG Loans, and we will see you on the inside.